So I was showing you a detailed example of how to use the unit rate estimating and the operational estimating methods to get a detailed estimation of a activity. Like we just saw an example of concreting activity. How will you make the cost of it? Again, not to frighten you, but go through these slides. More or less, they are self-explanatory. All these numbers, typically you need to estimate. I have taken some example values, of course, a little bit close to reality, but then slightly old number also. So this might not be the true representation. But you get the idea. Essentially, you need to club a lot of information in order to get a proper estimation of any activity, right? So for example, in this case, we started with a total cubic meter of concreting that needs to be done. We estimated hourly what is the peak cubic meter concreting rate that you need to achieve in order to achieve the project, overall project in time. According to that, we calculated how many number of equipments would be required, how many human beings for operating these equipment, how much is the fuel charges and all. In general, labor for concreting, concrete placing, concrete curing, transportation, all those things. The material costs, all those things I gave you a very detailed example. Right? Just go through it. And then we moved on to this topic of stock calculation for temporary structure. So typically the stock is easily relatable to the material stock on site that you have, right? For example, you might want to store some concrete, not concrete, but some cement bags, some extra reinforcement, because you never know when you actually need that. You might want to plan because there are always delays in supply chain. So, but at the same time, this is material stock. There's also this bulk stock, you could argue. One of that is this temporary structure. So these temporary structures are used throughout the project. So essentially, you calculate the total value and then you bill it or you distribute according to the percentage allocation in each month, right? For example, if you're expecting 2% of the work to be completed in 1 month, then the total value 2% of the total value will be attributed to that 1 month, just for an exercise of attribution, right? And then with that, I had briefly introduced the term called working capital. Again, we are not going to go too detailed into working capital at this moment. We will revisit the topic. But the main idea of working capital is the capital. By capital, I mean money. The money that you need to have in order to smoothly run the project, right? Finally, you take this money out of. This is not a cost. This is not a cost. You do get this money. But while executing the project, you need to have this extra cash in hand to manage the project. Because what happens is, you have to pay sooner than what you get paid for, right? Similar to your bank balances. Like, okay, if your monthly expenses and your monthly salaries are matching exactly, it doesn't mean that during the month you don't need extra bank balance in your account. You cannot start with a zero bank balance at the day one of your month and expect, well, otherwise you will soon go negative because your salary gets credited 1 month later, but your expenses are being paid right now, right? So these kind of things do happen. Even in construction industry, we do have like credit system. For example, you have a personal credit card where the cost is now, but you promise it to pay it 1 month later when your salary comes. Same thing happens even in construction industry. The industry in general works with a lot of informal relationship. So, for example, the contractors also might negotiate a deal with the vendor that, hey, I will not pay you every day. It's too much work to just pay you every day. I'll pay you maybe every 15 days or maybe every 10 days after you have supplied the material to me. So, these kind of things happen. So, yes, to certain factors can reduce your requirement of capital or working capital. Certain factors will go against you in terms of working capital. For example, if client is not paying you as frequently, then it's a huge requirement. Also, the type of contract. For example, the contract is that you get paid only after completion of the whole project. So if your project is of 450 crores of cost, then that is your working capital requirement. Right now, you need to pay those people to get the work done. Otherwise, the work will not be done, right? So this is the main idea. So working capital is the cost required or the capital required to run the business. But finally, it is not a cost. It can be taken out. A net, you will still get your money out, right? But financing the working capital could be a cost that you can attribute to the project. If you would not have done this project, that 500 crores would be earning some money somewhere in sitting in your account, right? But since you have put that money in this particular project, you may want to distribute it in terms of the costing. Cost to borrow money will be also included in this particular project. So those kind of calculation do happen, right? But let me again, I'll not go too much detail, but I'll give you some basic idea of how to calculate and what's the requirement. So let's say for a given project, the contractor has estimated that he would be required to keep a average stock, which we just calculated in the previous question, which is the basic stock and the bulk material. Materials already was given. Basic stock of temporary structure we calculated using the percentage of the total invoice value, right? And this is given to you 20 lakhs rupees. Further, it is also estimated that average outstanding and average unadjusted advance would be 270 lakh rupees and 60 lakh rupees. Do you know what is average outstanding? Yeah, so this is the money that you should receive but you have not received yet, right? So this is perhaps a client is not yet to pay you for this, but you have done this work and therefore there is a cost associated with it, but the client has not paid to you, so it's an accounts receivable. And you do know what is unadjusted advance? Have you heard this term in your contract class? Not necessarily payable, but this is typically the client can sometimes give you an advance to start the project, because they also know that you will need money. Not everything can be expected to pay at the end only. So they also give you an advance amount. That amount definitely will help you because you don't need that much money to keep in the working capital requirement, right? The client has already given you some money already ahead of the project. Outstanding is the client that has to pay yet. So you need to manage that on your personal money right now. And the stock. Stock is ultimately, it's your cost. Ideally, you should have a supply chain which is so optimal that you don't need to keep the stock. But if your supply chain is not, then your stock value goes high, and that is something on you because that's some money that client will not pay. That is the cost of you keeping the project running as smooth as possible, right? So the average working capital then becomes the monthly stock, the outstanding minus the unadjusted value. So stock is that you need to pay as a cost. Outstanding is something that you have not received the money from client, but you still need to pay because people are asking that money from you, minus the money that you have already gotten from client. This much money you need to put in system for it to keep on running smooth, right? So that's the concept of working capital computation. Of course, it is not a fixed. I'm talking about average here, but working capital requirement will also follow a trend like this, right? In the project, in the beginning, the working capital is not high, but as the project reaches peak and the delay from client payment goes higher and higher, you will have a typical such kind of a curve for working capital requirement also, right? So working capital is the money you need to ensure the project. It is finally yours. It is not a cost to the project. Finally, you get this money out of the system, but during the project, it is involved in the project to do the activities. That's the main concept, okay? And the cost to this money, whatever cost you have incurred to borrow this money, should be properly accounted in the project cost. So when you say about, for example, your cost of the project will be 450 crores and you have made a bid of 500 crores, in that 500, the 50 crore margin that you are having, it's not only your percentage profit, but also some of these cost of working capital should be reflected there, right? Understand? The idea of working capital, again we will relook, if the time permits, we will relook into this, but this is an extremely important concept. Typically in construction projects, the working capital requirement is huge. And because of the huge requirement, it also serves as a barrier to entry, right? Not anyone can start a construction business immediately because this much money you need to have in order to generate even getting the project. And as I was mentioning that a lot of clients, they ask for your financial performance. The reason of financial performance is not about they care about your profitability. The only concern of the client is whether you are able to get the working capital requirement to meet the project requirements and will guarantee that the project will actually go smoothly, right? And I gave an example, if as an annual turnover of a company was just 1 crore, For 1,000 crore projects, you might expect that at some point of time, you may have to have the working capital of some 100 crores. So if your total balance or total revenue last year was 1 crore, how are you expected to raise 100 crore to fill that requirement even temporarily, right? So that's the kind of judgment the clients also make for this kind of contract selection. All right. Then there is also this idea of fixed asset. And as I was telling you that sometimes you have machinery, plant and equipment, which is not attributable directly to a specific project because the activity will be distributed throughout. So that's also something that you need to allocate for a particular project. So let me give you an example. For example, a project requires total 4 types of equipment. The approximate book value of an equipment on arrival at the site is given below. The contracting company follows a straight line method of depreciation and rate of depreciation is 1% per every month. Calculate the average fixed asset employed by the contracting company for the project, assuming that mixer machine, weighing balance and builder's hoist are required for 10 months and dewatering pump is required only for 6 months. So these are some of the assets that the company owns and they keep on using it for multiple projects, not for single projects. So that is the how much of that depreciation should be allocated only to a specific project is the kind of calculation we are doing. Again, showing through quick examples. So here, let's say the book value of the mixer machine, the weighing batcher, the builder's hoist and the dewatering pump at the arrival of the site is given in these numbers. The number is also given and the requirement is for 10 months and for this it is the 6 months, right? So how do you estimate the average, how much asset has been allocated only to this project using this method? So your opening book value, let's say for mixer is whatever is given to us. You know that the depreciation is 1% per month and you are totally using this machine for 10 months, right? So book value at the end of 10th month just for this mixer machine would be what? 11, the whatever this 1,12,000 minus 10% of 1,12,000 because 1% each month, 10% you are totally removing. So this book value is this much. So the average for 10 months is essentially average of the opening and the closing book value is this particular. So this particular asset, the average value of this asset was allocated to this project for 10 months. That's the concept, right? Similarly, for weighing batches, building hoist and dewatering pump, you can do the calculation. Here instead of 10%, since it is used only for 6%, I have given that in the question, you are only reducing it to 6% and you get the final value, right? So the total of each of these assets in terms of the amount that has been deployed at that particular site is this much money, right? Now this also becomes part of your, there's something called again average funds employed calculation. Not to confuse you, all I'm saying is there are many things and accounting is slightly tricky. One is based on the nature of the assets, right? And something, there's a concept we will soon understand is called fungibility of the assets in a way that how quickly can you convert them in cash, right? The more cash assets is the better. But of course, these require slightly different way to do the accounting processes, right? For example, the working capital, it's actually capital. It's more or less a liquid money in a way that cash, it can be directly attributed to cash. You can immediately exchange it for goods and things like that. But an asset like a mixer machine is not immediately a cash, right? This is a slightly different nature of this asset. You cannot sell it immediately and get the same money, whatever it is there. Therefore, these different type of ratios are there. And the differences in accounting procedure also allow you to understand. When you just, for example, just talk about average funds employed, you will not have an idea of how much of this is actual cash, how much of this is actually machine. But if you know the working capital requirement and the average fund requirement, you know that, okay, this much of it is a cash kind of an equivalent, this much of it is actually some sort of an asset, long-term asset allocation, right? So this kind of distinction is important for people to know that out of this 100 crores that is stuck in a particular project, how much is actually pure cash that I can immediately leverage and how much is tied up in the machinery or some other form. So that is an important idea for a company to have. Also, it affects how quickly you can move one asset from another or one set of money from one project to other project. So therefore, this kind of distinction is made. Do not get confused. This is the next section. We will actually detailed coverage of what is assets, what is liability, all those things we will learn in the class. I'm just giving you a heads up on the kind of topics, right? So just an again further extension of the same question. So for a given project, the contractor has estimated that he would be required to keep an average stock equivalent of 20 lakhs, the same as previous question. Further, it is also estimated that the average outstanding and average unadjusted advance would be 270 and 60. I already explained this to you. Estimate the average funds likely to be employed for this project if it is known that the contractor would be required to keep an fixed asset of 50 lakhs, right? So the formula for average funds employed, again, not expecting you to remember. All I am trying to give you the flavor of the things to expect in the future. I'm never going to ask you, oh, this is blah, blah. I may ask you, but not so much detail, okay? Don't worry about it. So the average funds employed, now there are funds are of two types. One is the capital, which is a liquid. The other is the asset, because this asset for the moment is allocated to this particular project and that should be reflected properly, right? So average working capital is the stock that you need to pay for, the outstanding that you have not received from the client, minus the money, advance money that you have already received from client, plus the fixed asset value that we calculated earlier, right? So this is 280 lakhs. Now why this distinction is important? This much money, working capital is the money that the contractor actually needs to pay immediately. So you need to have this in form of liquidity, right? But this asset is coming from the long-term asset that the company purchases, right? So you can immediately sense the distinction. But average funds is the measure of total money that the contractor's money is tied up as a company tied up in this particular project, out of which 230 is liquid, 50 is coming from the company's long-term assets. That's why this distinction is quite important in terms of the liquidity of the content that you're talking about, how quickly you can exchange it to in form of a cash. In cash, you can change quickly in forms of a cash. That's the assumption, right? So that's the idea. Got it? So if I just give you 280 lakhs, you can either fund it from your long-term assets. That distinction does not become clear. Therefore, this working capital and the fixed asset allocation concept is important for you to distinguish how are you likely to fund these requirements. Okay. Again, we'll go into details of each of these accounting principles later, but just wanted to give you some ideas. All right. So this brings us to the end of this particular topic, mostly about how to begin the cost estimations. Let me switch to the next one. So now we are going to look at a topic called related, but something called revenue recognition. Anyone here has heard the term revenue recognition? Nobody is preparing for CFA or all? Nobody? BTech Janta, how will you get placement? Not studied this term? Never heard of it? Okay. So, you know what is revenue? Essentially the money that you get by selling your goods, right? But accounting has different ways to look at it in terms of when exactly do you say that revenue should be recognized in your books. By books, I mean your profit and loss statements and your asset balance sheets and all. When, as a company, when can you say that this much revenue has occurred to me or this much revenue I have already obtained, right? So, typically there are multiple ways to look at it. One is cash-based perspective. When you actually see that the particular sale of equipment or sale of machinery or whatever has brought real cash to your accounts. right? You have gotten the money in your bank. So that's the one principle. Other principle says that it's not about the actual cash transactions. You don't have to worry about that. But just the prospect that you will get this money, you should immediately start recognizing it. For example, I have sold you a good of 100 rupees. You have not paid me 100 rupees today. You are paying me 100 rupees maybe 2 days later. So a cash-based principle would say that I will recognize this revenue of 100 rupees 2 days later. But just the accrual principle, which we are more commonly use, will say that since you sold it today, or the promise of getting this money was made today, you will recognize this today. Right? That's the fundamental difference. Now, originally people started with cash-based systems. That when the actually money has come, then you should actually note it on your books. But that has a lot of problem because every business might have a lot of this credit and debt kind of a relationship, right? You pay today, but what if there is a return from a client? All this Myntra business and all this you talk about, you are not even paying immediately. You sometimes pay after the money has been, after you have tried a particular piece of clothing and all, and then you return something back and all. So meanwhile, what is happening to that does not get recognized properly in a cash-based business because asset has left your warehouse, but you have not gotten money for it. So where is the asset? Where is that gone? Books are not able to capture that when you only focus on the cash-based recognition. Therefore, this revenue-based recognition method about the accruals, like whenever the promise has been made by somebody that they will pay you X amount, that is the concept of revenue recognition. Okay. So in an online business, the moment you click to pay 1,000 rupees on cash on delivery or whatever, immediately it shows that revenue of 100 rupees has occurred, irrespective of whether the actual cash will be paid after the delivery. Right? So that's the idea. So now that you recognize both these, you can know in 3 days you had your asset was not doing anything. Essentially, you could not list it on your website. It was tied up in your kind of a working capital kind of a thing. So essentially, the revenue accrual principle, which we call, is like whenever the promise of revenue has been made, you immediately start recognizing in terms of your books. That's the principle. Cash-based accounting was a initial starting fundamentals. That's where a lot of people started. But today, most of the people or most of the accounting definitions focus on this particular definition, revenue accruals. Accrual is the promise of getting the money has been made, right? So, since accounting as a field has evolved, so has evolved the principle of accounting within the construction firms, right? So, construction also has the similar problem. You have long time periods for execution of projects. You don't know whether client will say that, okay, I'll pay you money 10 days later, but the actual money comes 30 days later. So, what is your revenue? Are you saying today when the client has promised is your revenue, or you are saying 30 days later when the cash actually comes to your bank? But at the same time, you are paying to your vendors. So, these kind of things create a problem, and therefore a more consistent definition of when exactly or how much revenue as a project has been generated. That information is critical, which I am just trying to get you an idea of how you will estimate it. And as I was explaining, based on this definition of cash-based principle versus actual accrual principle, this method also have evolved over the time, and those are the 4 methods that we will look into. These 2 are more or less obsolete. Nobody uses them. This kind of contracting is rarely used anymore. So therefore, this again becomes kind of an obsolete method. Ultimately, we use a method called percentage completion method for revenue recognition. But I'm just giving an overview of what exactly is there. Okay. This is also recognized by Indian accounting system, abbreviated as IAS, which I just read in the morning today before coming to this class. So Indian accounting principles for construction companies also define this method of recognizing the revenue for a project. Okay. So, what all you need to know in order to solve this kind of problems. Ultimately, I'm pretty sure that's what you care about, how to solve the problem on this kind of questions. So, you have 6-7 type of items that you need to understand about, right? This is essentially, you can call it as a snapshot of financial condition on a particular project. Let's say your project is of 12-month duration. At 10-month duration, you asked about what is the condition of my different accounts, cost and all those things, and this kind of information you can easily obtain. What is this information? Contract value is the original contract value, whichever basically you are likely to get once you complete the project, right? Let's suppose 5.5 crores or 500 lakhs, let's say, whatever that is. Original estimated cost of the contractor to complete the contract. Contract value is 500, but as a contractor you have estimated that your actual cost will be only 450 lakh rupees, not the 500. The remaining of it is what? Profit margin, some sort of a risk assessment and all those things. You are essentially saying my cost will be 450, I am going to get paid 500 for this, right? Billed invoice to date. Do you know what is billed invoice? So essentially in contracting, in real construction projects, to get paid, you need to raise an invoice. If as a contractor you don't even raise the invoice, the client is not going to pay you. Client can only pay you for an invoice that you have raised. Invoice is, hey, this is the work that we have done and here is the money that you owe to us. That's the invoice raising concept, right? So even when you, in a day-to-day thing, you don't realize it, but even in IIT, when we have to procure something, we first ask them to give a quotation, right? Quotation is their estimate of this much money they will require to complete a particular task or whatever the services that we are asking. Once, based on that quotation, we agree that, okay, this price is okay for us, and we give them a purchase order, which is essentially, okay, we agree to buy on this condition. Then they raise an invoice. Invoice is, okay, based on this discussion between us, this is our final value, this is the official value, how much of this will go to taxes, how much of this is going to come to our accounting, this is the bill for, this is the account where you can actually pay the money, and these are the terms and conditions for us to get the money, right? On that, we decide the payment schedule. It's like, I will pay 50% now, I will pay 20% at the time of delivery, I will pay 30% after you have shown me that everything is working fine with this computer or machinery that I am buying to you, right? That is, so this kind of a transaction, zigzag things happen. If there is no invoice, I cannot pay you money. As a client, I cannot pay you money. Invoice is the commitment that, okay, this is the final thing that we have done, this is the quantity of work that we have executed, and we need this much money for this, right? So, in construction projects, since you are talking about months or years, you cannot expect to be paid only at the end of the project. So, typically there is a cycle that is predetermined in the contract document. It's typically month. So, every month you raise the bill that we have finished this much quantity of work and we are eligible for getting paid for this much quantity of work. If the client approves that yes, indeed you have completed this much quantity of work that you have raised invoice for, they agree to pay to you. Otherwise, they can ask you to revise the bill, right? Got the idea? Bill is essentially you are asking this much amount to the client, claiming that you have completed this work, right? Payments received to date. What is this? Any idea? You might raise bill for whatever. This is the money you have actually received from client. This is essentially what client has approved and paid to you, right? So obviously there will be some difference between these two numbers. These cannot be 100% matching. Definitely payment received to date cannot be more than billed. No client is such generous in the world. You could trick them on theoretical basis because at the back of the day, you know how is the cost margin is all. But in terms of the project value, no client will ever do that, right? But yeah, the idea is that you need to minimize this gap if you want to reduce your working capital requirement, right? How fast the client can pay to you, that can reduce your working capital requirement. Okay. Now, cost incurred to date. Any idea what is this? Not necessarily out of 350, but essentially the cost that you have incurred to reach to this level of construction project. It is, yes, ideally it is about, okay, this much billing I have done, and in that how much costing I actually did. because more or less these cycles are in sync in terms of the payment. Everyone does this activity towards the end of the month. Last week they devote this, okay, how much bill to raise, how much we need to pay to our contractors, subcontractors and things like that. But ideally this could also be slightly different. It could be the actual cost that is incurred to you. Maybe you have not raised the bill for that. That's your problem as a contractor, right? But essentially this is the payment cost incurred to date. So theoretically it can go higher than bill. If you as a contractor are not proactive in raising the bills, theoretically this can go very high, right? Because, or for example, if the contract is that you get paid only after the end, the billed invoice to date would be 0 in the middle of the project, but your cost will actually be there, right? Then there is something called estimated, which is the forecast cost to be completed. From this point on, if you want to finish this project, how much more money you are likely to require. This is the estimate of that. This estimate can keep on changing. This is more realistic. Everything else, contract value is predetermined. You can't change that now unless there is a revision of the scope of the work and things like that. But essentially this forecast is more real time. Depending upon current market prices of your raw materials, your labor supply, all those things can influence this number, right? And then finally, cost paid to date. What is this? Yeah, so out of incurred, how much you have actually paid. So your vendors might have raised invoice to you, but you may not have paid to them, right? So they have raised invoice of 333, but you have only paid them 300. That's the idea, right? So it's contractor is in the between. On the one hand, the contractor is dealing with the client, and on the other hand, contractor is dealing with the vendor. Contractor raises the invoice, client pays the money, vendor raises the invoice, contractor pays the money. All these values are given here. Got it? So this kind of information you can then use to recognize whether your project is actually going in a good condition. Have you financially, is this making sense? Do you need to do something from a project management or a finance management perspective on this particular project? And particularly that concept of the revenue recognition, right? So any question on this information, understanding this information? Clear? Everyone? All. So the first method of revenue recognition, I'll again come first, let me go through 1, 2, 3 methods, then I will come to the main differences between them. But essentially first is cash method for revenue recognition. The revenue for the project at any point of time is calculated by subtracting the cost paid to date from the payments received to date. This is essentially how much cash you have in your hand. You are some money that you have received from client versus how much cost of that you have paid to your vendors. So this is the net money that you hold in your hand right now, right? Essentially that's the cash that you have. So representative of the actual cash transaction that has happened, right? Revenue is payment received to date minus cost paid to date. So from this data, revenue received to date is what? Payment received to date is what? 315, and the cost paid to date 300. So your actual net cash in your account is about 15 lakh. Okay, this is a cash based principle. You are only paying attention to when actually cash gets transferred to your account or actually flows away from your account. That's the principle. But as I told that in general, there is a accounting as a field is evolving from cash to this accrual kind of a principle. That's where new methods started to evolve. The second method is straight accrual method for revenue recognition. In this, the revenue of project at any time is calculated by subtracting the cost incurred to date, even if it is not paid from the billed invoice to date, even if the billing amount has not been recognized. So originally you were dealing with cash only. This is about the billing side of it only. How much have bills you have raised versus how much your vendors have raised the bill for you, right? So essentially, if you go back to this data, billed invoice to date is what? 350, and cost incurred to date is what? 330. So the difference of those will give you the remaining amount, right? The third principle in this is completed contract method for revenue recognition. In this case, the revenue is recognized only when the project has been completed. So there is no intermediate payment of any sort. Essentially, the full revenue gets recognized when you complete the project. So in this case, revenue would be zero at any point of time between the project duration, right? And since the project has not been completed, in cases where the contract extends to several years, the company will not be in a position to show any revenue during the interim period, right? So as a company, if you suppose you are doing 5 projects simultaneously and for 5 years you have not showed any revenue, how do you expect the business to continue? From other financial investors, if you want to raise more money, they'll be like, where is your revenue? You are not doing any business. How do we even trust you that you are actually doing this business? How do we raise this? So then you need to submit also the contracting account, the payment schedule, and blah, blah, blah. No bank wants to worry about that. So essentially, you need to have a rather sub-continuous method. This kind of method is kind of becoming obsolete. More or less, these contracts are also going obsolete. For small contracts, still okay. Like if it's just like a minor repair in your house, maybe okay, once the repair is done, I will pay. Meanwhile, everything is getting done by small contractor. But any large contract, you need to have more or less interim payments. Otherwise, it doesn't work, right? So for long duration project, this method has obvious drawbacks because for 7 years, you are not showing any revenue and suddenly you are showing any revenue. So it also gives a feeling that you have very unexpected or unpredictability in revenue. For 7 years, 0, then suddenly 1 million. That cannot be the case. And for another 7 years, 0, and then some. So it's also unpredictable for the banks to trust you. So this is essentially not good for long projects. So we will not go into detail. There's nothing to go in detail. The revenue recognized when the project is finished, right? Now comes the method which everyone is using these days, and essentially you will also notice that there is a difference in what revenue was being called, or the definition of revenue in the past 2 methods versus the current actual method that we are going to use from now onwards, right? So essentially, this is based on percentage of completion method. Okay, 2 steps. First is you need to define how much percentage of project has been completed. And the second is you need to determine the revenue, which is essentially the total cost multiplied by the percentage of project that you have completed. Now, percentage of project completion, how can you determine? What are the various ways to determine percentage of project completion? Based on the quantity, okay. How do you do that? Like some examples, small example. Yeah, so for example, we saw that 1 lakh cubic meter of concrete, out of that 60,000 cubic meter has been done. So your project completion is about 60%. Okay. What else? It can become complicated when you are dealing with multiple, because there is no project only for concreting. There could be different. So you can also estimate the average of that. What else? Milestones. What are the milestones? Phase completed, as in like the foundation work is done, now the pillar work is done and things like that. Yeah, could be the way, because typically there's a sequence of activities in construction. That is, you know that you can put pillars only when the foundation has been done. Ideally, that's the kind of world we are living in right now. So you have some idea, okay, total, you have a predetermined estimate. My foundation work was 10% of the total contract. My pillar work was again another 10% of the total work. So I know that, okay, total 20% of activities has been done, right? Any other ideas? Yeah, ideally you could do that, but do you want to do that? What are the drawbacks of doing that? Essentially, you are getting paid for sitting in office, not getting determined whether you are actually working or not, right? So therefore, typically people do not do on a time-bound manner. Like, yeah, if it is a 2-year project, it's on the actual work. You could be sitting for 1 year doing nothing, and you can't call that 50% work has been done, right? So that's the problem. But yeah, it can be done in certain where you are assured that output is continuous and you can show that. Right? Any other? One is written on the board. Expenditure. Yeah, so that's the kind of idea. So all this that you gave me the examples are based on actual measurements of the work done on the site, right? But in financial terms, you can also do in terms of the cost, total cost perhaps you are expected to, how much compared to that, how much cost you have actually incurred. That kind of a judgment can give you. Of course, there are drawbacks in that because it could be possible that momentarily you reached higher cost because of some reasons, but now the value has gone down and total value is still not there. So your percentage errors will be there for sure. But from financial side, this is the one recognized definition where the percentage completion is defined as cost incurred to date divided by cost incurred to date plus estimated cost to complete. So this is on the cost side. This is not on the revenue side or the billing side of the cycle. You could also do that. There's nobody stopping you from doing that. Amount billed to date versus amount billed to date plus total amount that you are expecting to raise further, right? All those things are there. But amount billed is little bit not in your control. That's also dependent on client. Cost is something that is you are realizing as a contractor. So this method is more good, reliable estimate you could have from these numbers. You will be easily estimating these numbers all the time, right? And then the revenue is essentially the percentage completion multiplied by the contract value, right? So for the example that we were looking, our contract value is what? 500 lakhs. Our cost incurred to date is what? 333. Plus how much more forecast for the cost that you are going to pay, right? So that's what? 135. And you multiply this by your total contract value. So you will come out to be, the revenue will come out to be 355 lakhs in this case. The percentage completion is coming out to be about 72% or 71%. You can easily notice the difference in the quantity of revenue in this method versus the previous methods. Previous methods you were dealing with like 17 lakhs and 15 lakhs like of a number. Here you are dealing with 355 lakhs kind of a number. This is more true definition of revenue. Revenue is usually higher. Those that is more or less a estimate of in terms of how much margins you have currently. That is the rough estimate of that. In this case, the gross profit to date would be the revenue that you have recognized minus the cost that you have actually incurred. So this is essentially out of the 50 lakh that you are expected, or somewhere what, 333 plus 135, 500 minus this is the total profit that you are expecting, right? Out of that, about 22 lakhs you have actually gotten so far. That's the kind of estimate. So this is a more acceptable method, and this is the most standardized method that a lot of companies use and also described by our Indian code. Okay. So how do you use this kind of a data to get a report of construction projects, multiple construction projects? What happens is, as a client or as a contractor company, you are many times executing like multiple projects parallelly. So you would want to know what is the financial status of each of these projects. Are they running fine? Are they not running fine? How is my client relationship with on each of these projects? Am I incurring any losses in some of them? Am I making profit on some of them? Is the payment schedule fine? Not? Should I put some pressure more on the client for a particular project and things like that? So this kind of a decision making is more for headquarter people, right? They would want to monitor multiple projects. As a project manager, you are worried about only this table and more or less dealing with this. But as a headquarters, you are worried about at an overall level how different projects are performing, right? So you could use the same method to also do that. How is exactly what I'm going to show you, right? So I'll start this topic tomorrow, then we'll take it forward from here. But essentially, I've already shared the slides. You can also come look at them before we start the class tomorrow.